Investors Chronicle.
Hello and welcome back to the IC Interviews podcast. I'm Dave Baxter, the funds editor on the Investors Chronicle, and today I'm joined by Charlotte Yonge, who works on the Personal Assets Investment Trust and the Trojan Fund. I should first note that we are recording this on Monday, April the 14th. Of course, fresh developments have been coming thick and fast when it comes to tariffs and the chaos that's currently taking place in markets. So there's a very good chance that fresh developments again will have happened between now and when we publish this recording roughly a week later. Charlotte, thanks very much for joining me. How are you getting on?
Thanks, Dave. Thanks for having me. Yeah, we're getting on okay, thank you. It's been an interesting 10 days.
Yeah, good use of the word interesting there. So clearly it's been what we might describe as a topical week or 10 days or so. Lots of turmoil in markets. It seems like almost every day there's kind of a fresh twist in terms of Donald Trump's trade war and kind of different nuances to that. So firstly, I just wanted to look at, Personal Assets, for example, tries to preserve wealth and help investors during these more kind of turbulent times. How has the portfolio been behaving in the recent sell-off, and how is that affecting your thoughts about how you're positioned?
It's a great question. So it's really crucial as well to what we're trying to do, which is not lose money. That's the first part of our mandate, is to preserve capital. And kind of part of that is over long time frames. We want to make sure we don't lose money. That's obviously key over 5 years. But almost the harder part of that is making sure that we are really resilient in periods of volatility as well. And I spoke to our head dealer last week about whether he'd seen anything like this. He's been working since he was 16, and he's now about 40 years older than that. And he said that this is pretty unprecedented in terms of his experience of volatility in both directions. You've had those really red days where everything's down, but then you've also had the bounces just based on a single tweet or a headline, which has made it, really challenging for investors that don't want to have such a bumpy ride. And that's really what we want to deliver for our end clients. We have held up well. So year to date, and this is clearly as at the 14th of April, but we are up just under 1% now. And we sort of have experienced a little bit of a drawdown, so around 2% since the highs. But really, that's what we're focused on, is minimizing that drawdown. Now, it's not to say we wouldn't necessarily have more pain to come, but the way that we position going into this is very cautiously. We had just over 30% in equities coming into a fortnight ago, into Liberation Day. And we have added at the margin, but we remain quite cautious today. So around a mid-30s exposure now that we've added to equities. And alongside that, we've got some gold, which has been very helpful as an offset. We also have some inflation protection, which we can talk more about as well. And that has been resilient. So it's, I think, early days in terms of the volatility. And that's why I'm cautious about saying too much about how we fared, because I think people will be judged in a year's time, 18 months time on all of this.
Yeah, that makes sense. So we'll get into the bit more into the allocation in minutes, but it'd be interesting to see, and obviously this is quite a difficult task, but interesting to see what your view is on the kind of tariffs front. Like, has the team formed a view on what kind of endpoint we might be getting? For example, do we move into a tariff regime? Do we have some sort of complete climb down to zero in the end? And how is that affecting your thinking when it comes to the US and to other equity markets?
So it's a really hard thing to call. We are always very cautious about making a call on geopolitics. We often get asked prior to Brexit, for example, what do you think is going to happen? We don't know. Nobody knows. We're not going to pretend to know either. And even if you did know in advance, you might not necessarily get the investments right. So, for example, Trump being elected the first time was seen as pretty cataclysmic. It certainly wasn't in any of the bookies' probabilities or the betting markets. And yet it was actually really good for the equity market first time around, 2016. So just because you know doesn't mean you can predict. What we kind of are focused on is the longer term. And I think tariffs are they're just the latest symptom of an ongoing shift. And it's a shift towards more nationalism. So countries looking out for their own interests, reshoring of production. That was already happening before COVID. Clearly, this is a big step change, and we don't think that it's unwound in the next 90 days necessarily. I think there's a very clear signal of intent that we had evidence of before now, but certainly as of Thursday, 10 days ago, or 2.5 weeks ago, when we get to this podcast being aired, that was a real step up in terms of this increasing nationalism. And they're very clear that this is not really about stock markets. This is about the man on the street, the woman on the street in the US. It's about Main Street rather than Wall Street. And what that means is they're probably likely to suffer a little bit more pain when it comes to financial asset prices, because what they want to end up with, and again, don't think this is necessarily going to be achieved by tariffs, but what they're very clear that the Republican administration want to end up with is a reindustrialized America and a manufacturing base that creates jobs, particularly in that Rust Belt of America that voted for Donald Trump. So I don't think it's a quick unwind or row back. What are the implications for investors? I think there are a few things. Tariffs are, first of all, a big tax increase. They're a big increase on consumer goods. Huge amount of consumer goods are imported, and those are going to go up in price. And even with the latest kind of reprieve that he's given, this sort of 90-day, because of what's happened with China, the bilateral chat with China, is still about a 25% increase or a little bit more in terms of the cost of those goods. And that's going to be inflationary. So that's not going to be great for the US consumer. There's sort of this additional element, which is just the massive uncertainty and the loss of trust. So anyone who is running a business out of the US or out of the rest of the world, but operating as well in the US, they're just going to defer decision making. And we're seeing that. We can see CapEx, so capital expenditure plans at a corporate level have just fallen off a cliff, because no one's making any hiring decisions, no one's making any big investment decisions until they know with a little bit more certainty what the administration is going to do next. And that in itself is potentially really quite damaging for growth. And I think that's our bigger sort of long-term view on all of this is, there's a risk of a recession now, which is much higher than it was at the start of the year.
So what does that mean in terms of kind of equity markets you are favouring? I guess, first of all, how do you now feel about US equities? I mean, there's obviously been a big debate about, at the start of this year, everyone was very bullish, or lots of people are very bullish on the idea of US exceptionalism enduring. And now some people think there needs to be more of a kind of political risk premium on US equities. And I would imagine we'd see plenty of kind of investors looking to diversify more into, I don't know, for example, Europe as one kind of location. What's your kind of stance so far?
I do think this is right. There's definitely been, particularly when it comes to just dollar assets in general. So whether that's Treasuries, whether that's the US stock market, and particularly passive investment, you just buy the S&P and you go on holiday, and people just did that with very nice results over 2023, 2024. The S&P was up 25% and 26%. And that has basically anchored people to think, right, I can just buy this stock market and hold it. Now, and frankly, when there's volatility, buy the dip. And what we have seen in terms of retail flows the last 10 days retail investors have been stepping in again and just buying. They're just buying ETFs. They're not net sellers at the moment. So I think it's got a longer way to run. Your question on, do people move away from US stocks? Yes, I think there is definitely going to be more downside in potentially in US stocks as a whole. I think that's our base case, that there's a risk of more downside there. It's partly because of this move away from the US. I think it's more because of the fact that valuations are high and there's now a risk of recession. So earnings are also at risk. So the multiple that you're paying on earnings is still above longer term averages. And those earnings, in many cases, are at their peak, cyclical peak. I think that's the biggest risk. And then your question around US exceptionalism is really important when it comes to currencies. So we have dollar exposure, which has really helped us in the past. So COVID, 2022, also the financial crisis, dollar was really strong against sterling. That helped offset some of the equity volatility that we experienced. I don't think we've got that today. I think, and this is again, what are the longer term ramifications of the last 10 days? And it's probably that the dollar is not the safe haven that it used to be. And frankly, that people are moving away to other markets when it comes to US Treasuries, but also just US dollar cash as well. So we reflected that in the portfolio. We've reduced our dollar exposure by 10% in the last 2 weeks. And we have around 15% net dollar exposure. We're hedging a lot. We do still own a few US companies that we think, frankly, over the sort of 5 to 7 year time frame that we give ourselves, we think will be fantastic investments over that time frame. But there'll be a lot of capital flight away from the US and not just from the stock market. I think treasuries are clearly kind of in the eye of the storm here as well.
I was interested to sort of turn to treasuries because I think if I look at the end of February, they made up, nearly half of, say, personal assets. How are you treating that now? Because, yeah, as you mentioned, I suppose US assets across the board have been out of favor now. For example, if you look at the 10-year, treasuries have sold off more than gilts. Do they now have kind of weaker defensive qualities? And are you going to kind of, shift more of the balance, for example, in favor of gilts when it comes to bonds?
Yeah, so we have already been doing that. And again, this won't be in the numbers yet because this is since the start of April.
Yeah.
But we have been reducing our treasury exposure. We've actually started some exposure to the Japanese yen via Japanese government bonds. I think the yen is more likely to be a safe haven. And there's also the fact that it's relatively cheap. It's certainly cheap versus its history against both sterling and the dollar. So we are diversifying away already. And that US Treasury exposure that we do have that remains, it's relatively short duration. So it's under 5 years duration. And we think that makes it much less vulnerable to the volatility that's happening at the long end. A lot of the concern is around inflation. So yields are moving around because people are quite rightly concerned that even though this might not be good for growth, the tariffs are going to add to what is already an inflation rate above target and could quite well mean that we experience a multi-year inflation problem. And let's just remember, we've already had inflation above target for 4 years. And so it's already multi-year, but it could become more structural in nature. And it's very clear that the bond market, the conventional bond market, doesn't like that. It's concerned about where yields are going to have to go. But there's also the point that we were mentioning around people moving and potentially foreign governments moving away from treasuries at the same time. So there's a flow aspect to this. I think what's quite important as well as the low duration point, so minimal duration, therefore we expect to hold these securities for the most part to maturity. So we know that the yield, for example, on a 5-year inflation protected bond is just under 2%. That means you're going to get, if you hold it for 5 years, unless the US defaults, which I would say they don't need to default because they can buy their own debts. They have currency sovereignty. So we think that is not likely. Over those 5 years, because of that real yield, you're likely to get 2% on that bond. You will get 2% on that bond plus whatever inflation turns out to be. So if inflation is 4, you're going to get a 6% annualized return, which we think in an environment where we're worried about equity valuations, we think that's pretty nice. And that inflation linked component, I would say as well, is really important for us because we do think that's a bigger risk now. It was clearly a risk following COVID, and we wanted that inflation protection then. We think it's just increased because of what's happening in tariffs as well.
What else works if we do have more of a kind of structural inflation? What else is kind of, winning a place in the portfolio?
Yeah, so in the equities, we like businesses that have pricing power. We invest in companies that, frankly, have really strong brands. They have ability to earn really good margins, really good gross margins. And that means that if there is a period like we had in 2022, they can actually charge a premium for those brands. So, for example, the likes of Visa, the payments network, which is one of the largest holdings in the fund, they earn a very, very small fee based on transactions. Clearly, those transactions, if we go into a recession, may suffer. But if we have inflation, that fee is able to increase with inflation because of the fact that it's a very small portion of the overall cost of a payment. And it's an ad valorem fee. So as the value of those transactions increases, as it will do if there is inflation, then Visa's revenues will rise accordingly. The same goes for, we think about something like a Microsoft. Microsoft has pricing power because, who are they competing with in business software? Well, there are a few companies, but do I really want to replace my Excel with something else? It's incredibly sticky. And, frankly, the fact that Excel and Microsoft Office doesn't cost businesses very much the total of their overall expenditure, they can increase their prices as they need to. So that's within equities. Those are the ones we like. Frankly, valuation matters. I've given you 2 stocks that are, getting a little bit cheaper, but they're probably fairly valued. We don't own more of them today because we think valuation is particularly sensitive to inflation. We own the likes of Heineken on 13 times earnings versus Microsoft, which is on sort of 25. That's we think a pretty good margin of safety, and we've added to Heineken recently again with a brand that has a lot of pricing power. So I think that's the way to navigate in equities. And then just in terms of other asset classes, we do own gold, which I know we've mentioned. We think ultimately in inflation, gold is that oldest currency. It's 6,000 years old. It's a currency that can't be printed. It can't be devalued in the same way that the pound or the dollar can be. And it also has historically been a very good hedge against monetary instability. And I think that's the environment that's here to stay.
Yeah, you've recently published a pretty bullish note on gold, and obviously, the prices have been soaring in recent times. Is there anything in terms of either price or kind of development that would cause you to be a little bit more cautious there?
We have taken quite a lot of profits out of gold. So we went into last year with 12%. And if we'd done nothing, it would now be around 20%. It's actually just over 12 still. So we've taken out a lot of the profits. We managed that within a sort of 8 to 12 parameter, just in the knowledge that you can have periods where the gold price is quite volatile, and we don't want it to influence the whole portfolio to the extent that it can cause quite a material drawdown. We are also positive on gold, even from here. The reason that we think this sort of bull market in gold has got legs is the drivers tend to be fairly long-term capital. So it's central bank buying that has been the major underpin of gold price appreciation. Central banks tend to buy over a number of years. They still, and this is as at the latest data, so it doesn't reflect the last couple of weeks, but they still own about 57% of their FX reserves in dollars. And that has been moving. About 10 years ago, that was nearer 70%. So that has been shifting away from the dollar. We think that just continues. And what's happened in the last 10 days, the dollar has weakened. We don't think that's a surprise. And we hear that gold price has appreciated. What we hear in terms of flows is that it's moving, that those FX reserves are moving away from the dollar into gold, which we think makes total rational sense. What's the alternative reserve currency versus the dollar? I don't think it's the euro. I don't think it's the renminbi. It's probably gold. So we just think this is something that's going to play out over a longer time frame because of that amount that remains in dollars, that nearly 60% of central bank reserves that remain in dollars.
That makes sense. Turning back to your equities, you do hold quite a few sort of food and drink companies. You mentioned Heineken, there's Diageo, Unilever. How do you feel about those names in an era of tariffs? Because I suppose there is an argument that they could get sort of caught up in the crossfire.
Yes, so some are more influenced by tariffs than others. If you think about a Nestle or a Unilever, they have quite localized production. So they tend to have fewer imports within the US, for example. So supply chains are less of an issue, although there's probably a sort of low single digit impact if tariffs go ahead as they are now. Like, who knows how that evolves and changes. The spirits companies are slightly more impacted in that you can imagine versus you can manufacture a Kit Kat bar anywhere. You can't manufacture cognac or whiskey anywhere by definition. So they are more impacted. We actually saw a lot of that price reaction happen prior to Liberation Day. I hate calling it that, but prior to the day of tariff announcements, we did see a lot happen within spirits because that had been talked about in advance. The Trump administration had put tariffs on Mexico, on Canada, and also threatened on the EU prior to the global announcements. And because of that and various other factors, Diageo, for example, was trading on 15 times earnings coming into this month. So we think there was already a reflection of the risk in the valuation there. And we have added to Diageo on a little bit below that valuation. We did that a week ago.
Are you factoring in, I suppose a few fund managers have become a bit concerned about the effect of weight loss drugs on alcohol consumption and the knock-on effects they could have on some of these brands. Is that something you've kind of taken into consideration?
Yes, we've done a lot of work on these weight loss drugs, so GLP-1s. It's really interesting because there are lots of moving parts here. The first is how many people are going to go on them and stay on them. And we don't know. This is an amazing development in healthcare. There are huge, in terms of, frankly, beyond just weight loss, the fact that they can be used to treat a real variety of things and actually improve life expectancy for so many people, we think is really exciting. We sort of think about it in terms of lots of other implications for other investments. What they also do is they suppress appetite and they suppress impulses. So even people are shown to do less shopping when they're on weight loss drugs, which could be a good thing, maybe not for the economy, but they certainly can be used to treat addiction. And so, look, there are really good implications for consumer health more generally. We think premium spirits, so that's where Diageo plays, and where Pernod Ricard, that we also own, plays. Premium spirits, the data so far shows that they are much less impacted than or minimally impacted versus other categories. And the data is quite nascent, although I would say in the US, circa 20 million people are estimated to already be on these weight loss drugs, so, or at least have tried them. So there is certainly something to go on here. We were looking at one data set which shows that actually people will reduce their spending on crackers more than they do on alcohol. So it's not conclusive that there's an impact on alcohol. If you're playing in the premium space, it makes sense that you're going to be more resilient here, because you're going to probably, as a consumer, be spending more, but on better quality and on a lower quantity of that end product. And Diageo is well placed for that. And so is Pernod. So we think there's a lot that's gone into the valuation because of people's worries, and those worries are understandable. It's really uncertain. We're not going to know in advance, but we think there's a margin of safety in the earnings, which mean that actually they are fairly well set from here, and we think it's likely that they can withstand the headwind, whether there is even a headwind, but the headwind of something like a weight loss drug. It was worth saying, actually, the main thing that's happened in the last 18 months is people have gone from consuming a lot of expensive drinks in COVID when they were making cocktails at home to spending less because of the cost of living crisis. And so actually that's happened. That's been the reality in their operating results. The earnings have come down. It's been nothing to do with, or very little to do with, the weight loss drugs we assess. We just don't think that there is a strong linkage there. But clearly people are just building the narrative around these earnings, which frankly are just having a normalization after a very, very strong period in 2021.
Makes sense. And in terms of, we've discussed the US, but in terms of kind of equity markets more generally, are there specific markets that you're currently seeing standing out, or you're seeing more opportunities than elsewhere?
So we look at stocks on a bottom-up basis. We don't like to sort of say, oh, that looks interesting over there at a market level, because, if the UK market looks interesting, it might be because a lot of banks or retailers are cheap, and we don't invest in those sectors. So we are stock by stock, and actually across markets, lots of stocks are looking more interesting than they were. We've recently invested in, for example, L'Oreal and LVMH in the European market. But also we've recently invested in Adobe in the US market. So we're just looking for the best companies we can find on good valuations. And we don't like to generalize at a market level because there are lots of sectors that we just, for the reasons of cyclicality and low return on capital, we just avoid those sectors.
And finally, obviously, personal assets isn't the kind of only so-called, what people like to call the wealth preservation trusts. There are other names like kind of rougher capital gearing. What would you say are the kind of main kind of differences there for people trying to kind of understand and, weigh up what suits them?
So I won't comment on what other people do, but in terms of what we do, and this is to your point on stocks, we look to buy really great businesses. We actually think that buying brilliant businesses at good valuations is the best way to preserve capital over the long run. And when valuations are too high, we'll just lean back from stocks and invest more into other asset classes, so bonds, cash, and gold. And that's the way we've always done it. So we will hold great companies for 5, 10, in many cases 15 years or more. And if they're too expensive, we'll just lean back from that equity risk. And that's how we do it. And clearly we've been leaning in the last week. We will continue to lean in as markets go lower. We have a lot of dry powder to do that. We're long only. So we're not trying to time markets. We're not trying to do this in a complex way. It's very simple. It doesn't make it much easier, but what it does do is that it enables us to have time on our side. You invest in a really great company, then you really can just let it do the heavy lifting for you. I would say as well, in terms of personal assets trust, we are very conscious that we want to minimize that volatility. And as a result, we've got a discount control mechanism, which I know some other trusts have, but the majority don't. And it just means that if the shares are trading at a discount, we will buy them back in the market. And if they're at a premium, then we'll issue more shares. So the share price of personal assets trust tends to trade very closely to the net asset value, which just means you can get out very close to that, or you can buy in without being penalized as well.
And yeah, a reiteration of the long-term mindset is probably useful for people in these quite choppy times. But very interesting stuff. I'm afraid that is all we have time for. So Charlotte, I'd like to thank you for taking the time to chat, and thanks to everyone for listening. Take care. Also, do note we are due to publish an interview with Ruffer, another wealth preservation fund, in May. Keep an eye on our podcast page to see when that episode is released.